Looking at the market today, April 20th, 2026, I have a very serious question for you.
Okay, right.
Is this stock flashing a massive, just undeniable buy signal on a falling trend? Or are we staring at like a classic value trap, perfectly disguised as a breakout?
Oh, that is the question right now.
Because, I mean, you look at the sentiment, and half the market is calling it this severely undervalued generational opportunity, and then the other half, they're straight up hitting the panic button, warning about massive dilution and running for the exits.
Yeah, it is easily the defining financial tug of war of the year so far.
Yeah.
I mean, we're watching two completely different camps of highly sophisticated investors look at the exact same set of numbers and just arrive at violently opposite conclusions.
It's wild.
Tension in the tape right now is palpable.
Which is exactly why we are putting MicroStrategy Incorporated under the microscope for today's deep dive. Ticker symbol MSTR. Because the recent movement we're seeing here, it just defies gravity.
It really does.
The stock has surged almost 30% over the last week alone. And as we look at today's tape, it's trading at $166.52. That's up 11.8% just today.
Incredible single-day move.
Right, which pushes its market cap to roughly $58.84 billion. So we are going to tear down the mechanics of this move, dissecting the financials, the completely chaotic technicals, and that raging bull versus bear debate to help you, the listener, understand the engine inside this volatile beast.
Absolutely.
And hey, if you're tracking this wild tape with us on YouTube today, just take a second to hit that like button, subscribe to the channel, and you have to leave your feedback in the comments. We really want to know if you are buying this breakout or, bracing for a crash.
But before we pull the engine apart, let's just set the ground rules for how we're approaching this today.
Good call.
We are analyzing raw data and market mechanics. That's it. We're looking at both the bull case and the bear case completely impartially.
Yeah.
Nothing we discuss here is financial advice.
Right, definitely not.
We're simply decoding the signals and explaining the underlying mechanisms so you can form your own thesis on what's driving all this volatility.
So, to understand how a stock moves 30% in a week, we have to start by looking under the hood at the company's financials.
Yeah, you have to.
And the numbers here look completely bizarre if you try to evaluate them like a normal tech company.
Sure.
Because MicroStrategy has essentially transformed into this Bitcoin Treasury model.
Yeah, you really have to just throw out the traditional software valuation playbook here. Like, that legacy software business absolutely still exists, but structurally, it's been completely overshadowed by their corporate treasury strategy.
Let's put some actual numbers to that because it's staggering. So if you look at their balance sheet, total assets are sitting around $61.64 billion.
Massive.
And the vast majority of that is a stockpile of exactly 807,274 Bitcoin as of today.
Right.
But then you flip over to the income statement for the trailing 12 months and you get pure whiplash.
Oh, yeah.
You see this stagnant legacy software revenue coming in at roughly $477.23 million. But their latest quarterly net income, it is a loss, a catastrophic paper loss of negative $12.4 billion.
And that sheer scale, the divergence between the balance sheet and the income statement, is exactly what confuses so many retail investors.
Their earnings per share is sitting at negative $15.23.
Right.
And their operating cash flow is even slightly negative, bleeding about $67 million, primarily because they're relying on debt and equity issuance to just fund this ongoing accumulation of Bitcoin.
Yeah, exactly.
I was trying to visualize what kind of business actually operates like this. And it's kind of like owning a modest neighborhood hot dog stand that barely breaks even.
Okay, I like where this is going.
But the cash register has $60 billion worth of gold bars sitting inside of it.
That analogy actually gets right to the heart of the corporate structure. The hot dog stand, the software operations, is just humming along in the background. It might even be losing a bit of money on an operating basis because the owner keeps taking out these massive loans just to buy more gold bars to stuff into the register.
Well, wait, let me challenge that from an investor's perspective. How can a company with a $12 billion net loss maintain a nearly $59 billion market cap? Like, if I'm an institutional investor, why wouldn't I just go buy a spot Bitcoin ETF? Why take on the risk of the hot dog stand at all?
Well, it comes down to a few distinct Mechanical advantages and, honestly, a massive accounting quirk.
Okay, an accounting quirk.
Yeah, let's tackle the accounting first.
Yeah.
You mentioned that $12.44 billion loss. You really have to understand how GAAP accounting works.
Mm-hmm.
Generally accepted accounting principles.
Right.
Under current GAAP rules, MicroStrategy is forced to report what are called crypto impairments.
Walk us through how that actually works in practice. How does an impairment trigger a $12 billion hit?
It's an asymmetrical rule, which is wild. If the price of Bitcoin drops at any point during a quarter, the accounting rules force the company to record that price drop as an impairment charge on their income statement.
Wow.
Yeah, so it goes down as a massive loss, even though MicroStrategy hasn't sold a single Bitcoin. But here is the kicker. If the price of Bitcoin skyrockets the next quarter, they are not allowed to write the value back up on the income statement until they actually sell the asset.
Wait, seriously, so they are constantly logging paper losses during volatile downturns, but they never get to log the paper gains during the rally.
Exactly. It makes the net income look completely disastrous.
I mean, yeah, that makes sense now.
But the market knows this, right?
Okay.
Institutional investors look right past the GAAP accounting. They ignore that negative EPS, and they price the stock based on the underlying value of that massive crypto stockpile on the balance sheet.
Okay.
And then, to address your second point, why not just buy an ETF? MicroStrategy is actively using corporate debt to buy more Bitcoin.
Right, the leverage.
Exactly. They're essentially a leverage bet. If you buy an ETF, you get one-to-one exposure. But if you buy MicroStrategy, you're buying a company that is constantly taking out loans to compound their holdings.
Okay, so the fundamentals are basically this JAP-induced illusion masking a heavily leveraged vault.
Very well put.
But that brings us to the tape. Because clearly, the market is pricing in that leverage. Let's look at the price history. Today, we're hovering around 166, but the extremes over the last 52 weeks are just wild.
Oh, totally unhinged.
We saw a high of $457.22 back in July of 2025. Then it plummeted all the way down to roughly $104.17 just a couple of months ago in February 2026.
It is a textbook boom and bust cycle. And it's completely tethered to the extreme volatility of the underlying crypto market, but it's amplified by that corporate leverage we just talked about.
But looking at the technical setup right now, I mean, it is flashing strong, short-term, bullish signals. It's aggressively breaking out of a long-term downtrend and testing a one-month high up in the $173 range.
Yep.
The indicators are running really hot. The RSI, the Relative Strength Index, is at 73.65. The MACD is showing a bullish crossover at 8.510, which is strong momentum. Plus, the stock is currently trading above both the 50-day moving average, which sits near $139, and the crucial 200-day moving average around $135.
We need to pause on those moving averages, specifically the 200-day.
Okay, why is that one so important?
In technical analysis, the 200-day moving average is like the line in the sand for institutional algorithms.
Right.
When a stock breaks above it, quantitative funds and algorithmic traders often view it as mechanical confirmation of a major trend reversal. It essentially signals the winter is over and long-term momentum has shifted from bearish back to bullish.
And we are seeing buy-side pressure absolutely dominate right now. The volume is confirming the breakout. Over 52 million shares traded hands today.
Massive volume.
But let's go back to that RSI number of 73.65. For anyone who isn't, charting this daily, an RSI over 70 officially pushes a stock into overbought territory. It measures the speed and magnitude of recent price changes.
Right.
So if I'm a retail trader seeing a 30% weekly surge and an RSI pushing nearly 74, aren't I walking right into a trap? If it's overbought, isn't the elastic band stretched just way too far?
That is the perpetual risk with momentum trading. You're absolutely right about the elastic band analogy. An RSI above 70 tells you the momentum is red hot, but it also warns you that the price has moved up so fast that it's highly vulnerable to a sharp pullback or, just consolidation.
Yeah.
The danger for a retail trader is looking at that 52 million share volume, feeling the fear of missing out, and buying right at the resistance ceiling, which, by the way, is around $173.15 for the 13-week high, and then up at $196.
And if it drops?
Well, if the broader crypto market just sneezes, a leveraged stock with an overbought RSI can violently snap back down to its support levels, like down to $135 or even $123, instantly trapping those late buyers underwater.
Which naturally makes you wonder, With 52 million shares churning, who is actually accumulating this and who is quietly using the rally for exit liquidity?
Exactly.
And the ownership data here is fascinating. Institutional investors hold over 60% of the shares. That is massive institutional backing.
It really is. It proves that large mutual funds, family offices, and traditional asset managers are highly comfortable using MicroStrategy as their proxy for crypto exposure.
Instead of holding it themselves.
Right? It offers them immense liquidity.
Mhm.
They can buy and sell millions of dollars worth of exposure without ever having to set up a crypto wallet, manage private keys, or, deal with unregulated crypto exchanges.
And here's the big, but if institutional demand is that strong, you would expect the people running the company to be doubling down alongside them, and they
Yep.
aren't.
Yeah.
While institutions are buying, company insiders are taking profits. The filings show that Director Jared Patton just sold about $692,000 worth of shares here in April 2026.
So, to be fair, insider selling isn't always a glaring red flag indicating a lack of faith in the company.
Sure.
Executives sell stock for really mundane reasons, paying tax liabilities, diversifying their personal portfolios, or, buying real estate.
Right.
However, the timing is what catches an analyst's eye. When a director unloads nearly $700K right as the stock surges 30% and hits an overbought technical extreme, it strongly suggests that the people inside the building recognize the current valuation as a very advantageous place to take some risk off the table.
It creates a fascinating contradiction with Wall Street analysts, though, because the analyst ratings right now are pure chaos.
Oh, they're all over the place.
The consensus is officially a hold or a buy, but their price targets are wildly chaotic. They range from a low of $175 all the way up to $705.
That spread is insane.
Right. If you look at the specific signal breakdown, we have 11 strong buys, 1 moderate buy, and 1 strong sell. So you have 11 different analysts screaming strong buy to retail investors while a company director cashes out. It feels like a textbook case of watch what they do, not what they say.
It highlights the paradox of how different players manage risk, honestly. Wall Street analysts build forward-looking models. Their strong buy ratings are based on complex projections of where they think the underlying asset will be in, say, 5 years.
Whereas the insiders.
Insiders are managing their personal net worth. If your entire financial livelihood is tied up in a hyper-volatile asset, liquidating a portion on a massive green day is just prudent survival.
Makes sense.
But the extreme spread in those analyst targets from 175 to 705 proves that nobody actually knows how to accurately value this corporate structure.
And that split perfectly frames the ultimate debate sweeping the market today. Is this stock historically undervalued, offering a generational opportunity, or is it a massive value trap waiting to spring?
The million-dollar question.
Let's break down the mechanics of both sides. Starting with the bulls, they are arguing the stock is currently 71 to 75% undervalued.
They're incredibly aggressive with their models. The bulls are setting a fair value target around $567.89.
But how are they actually arriving at a number that high? You can't just pull $567 out of thin air for a company losing $12 billion a year on paper.
They're using discounted cash flow models, or DCFs. But here is the trick. Traditionally, a DCF model projects the future cash a company will generate from selling its products and discounts that back to today's value.
Right.
The bulls aren't projecting cash flow from software sales. They are essentially projecting future capital appreciation of Bitcoin. They're pointing to a 25% Bitcoin yield target for 2026.
Wait. Bitcoin doesn't pay a yield. It doesn't pay a dividend. What do they mean by a yield target?
Good catch. They're referring to the company's internal metric of how efficiently they are increasing the amount Bitcoin held per share of stock.
Oh, I see.
Yeah, the bulls argue that as long as the company keeps stacking the asset faster than they are diluting the stock, and the asset keeps appreciating, the legacy software business is completely irrelevant. To them, breaking that 200-day moving average mechanically confirms we are entering a new multi-year crypto supercycle.
But the bears are looking at the exact same balance sheet and screaming that this is a house of cards. The bear case claims the stock is roughly 51% overvalued, pointing to a true fair value of just $94.67.
Yep, completely different universe.
Because the core software business is stagnant. And their core argument centers on the one word that strikes fear into the heart of every retail investor: dilution.
That's the big one.
The worst-case scenario focuses on this. The share count for MicroStrategy rose by 16% in a single year just to fund these crypto buys.
And this is the crux of the bear thesis. To fund this massive Bitcoin accumulation, MicroStrategy doesn't just use cash from the hot dog stand. They continually issue new shares of stock and convertible debt, and they sell it into the market to raise capital to buy more Bitcoin.
Right.
When you issue 16% more shares, you are actively diluting the ownership percentage of every single existing shareholder.
Let's go back to our analogies to make sense of this. If the bulls are telling us to strap into a rocket ship heading for the moon, the bears are pointing out that the captain is actively paying for the rocket fuel by selling off pieces of the ship's hull.
That's a great way to put it.
They're financing the journey through constant dilution. At a certain point, don't you compromise the structural integrity of the ship?
It is the perfect visual for the risk they're running. Now, the bullish counterargument is that, yeah, we are selling pieces of the hull, but the fuel we are buying, the Bitcoin, is appreciating in value so rapidly that it more than compensates for the dilution.
Right. They believe the sheer velocity of the asset growth outpaces the drag of the share dilution.
Exactly.
But that entire thesis hinges on the price of the fuel only going up. If the price of Bitcoin drops, or even just trades sideways for 3 years, you're left with a smaller piece of a stagnant pie.
And that brings us to the volatility risk, because this stock has a sky-high beta of 3.57.
Let's define that. For you listening, beta measures how much a stock moves compared to the broader market. The S&P 500 has a beta of exactly 1. A beta of 3.57 means if the market drops 1%, this stock is expected to violently drop nearly 3.6%.
Massive.
We are talking about $8 billion swings in market capitalization happening on a routine basis. How does a regular retail investor survive a ride on a rocket ship with a beta of 3.57 without getting seasick and panic selling?
Honestly. Mathematically, a lot of them don't survive it. That extreme beta is precisely why retail traders get trapped.
How does the trap usually play out?
Well, the mechanics look like this. A retail trader sees the stock breaking out. They buy the momentum at the absolute top when the RSI is overbought. Then, the next week, the underlying asset drops 5%.
Which happens all the time in crypto.
Exactly.
Yeah.
But because of the leverage and the high beta, MicroStrategy drops 15 or 20%. The trader panics, sells at a massive loss to stop the bleeding, and then a month later, the stock recovers.
Brutal.
It really is. And beyond the emotional toll of the volatility, the bears also highlight a major structural downside called index risk.
Index risk, meaning the risk of being excluded from major market funds.
Yeah, precisely.
Yeah.
Because MicroStrategy has essentially morphed from an enterprise software provider into a leveraged holding company for cryptocurrency, there's a looming threat that major tech indices might decide they no longer qualify for inclusion.
Oh, wow.
Right? If they get booted from, say, a major mid-cap or a software index, all the passive index funds and ETFs that track those indices would be mechanically forced to sell their shares of MicroStrategy.
Wow. That would create immense, just indiscriminate downward selling pressure, completely regardless of what the price of Bitcoin is doing.
Exactly. It's a structural risk that has nothing to do with the actual crypto market.
So taking all of this inward, we have the Jap paper losses hiding the massive crypto vault. We have red-hot overbought technicals, massive institutional accumulation clashing with insider profit-taking. We have analysts projecting a $567 utopia and bears warning of a $94 collapse due to share dilution. How do we synthesize all of these competing forces?
The clearest way to view it is by separating the time horizons.
Okay, let's look at the short term first.
In the short term, the technical momentum is undeniably and fiercely bullish. The moving average breakouts, the bullish MSTR crossover, and that massive 52 million share volume show that the trend is currently your friend, despite the short-term weakness and pullback risks associated with that overbought RSI.
And long term.
Long term, you have to be intellectually honest about what you are buying. This is no longer a software investment. It is a high-stakes, highly levered gamble on a continuous Bitcoin treasury model.
So the ultimate best-case scenario is a sustained multi-year crypto bull run. If that happens, their leverage bet pays off exponentially, the asset growth dwarfs the share dilution, and those 500-plus price targets become a reality.
Precisely. And the worst-case continuation lower. That's a macroeconomic shift that cools the broader crypto market. The leverage works aggressively in both directions.
Right.
If the underlying asset enters a protracted winter, the gap impairment charges stack up, The balance sheet shrinks, the dilution continues to drag on the share price, and those retail investors who chase the momentum at the overbought top are left holding a very heavy bag.
Which means the next major catalyst is going to be absolutely critical. The moment where this high-flying technical momentum slams into hard fundamental reality is the Q1 2026 earnings report, and that is officially confirmed for May 5th, 2026. That is going to be a must-watch event for anyone exposed to this tape.
It will undoubtedly be the most important print of their year. That earnings call will provide a really granular look at exactly how much new debt they've issued, the exact scale of the share dilution over the quarter, and how the recent price action has mathematically impacted their balance sheet.
Which leaves us with one final, deeply provocative thought to chew on. MicroStrategy is aggressively funding this historical accumulation through continuous debt and equity issuance. It is a financial machine perfectly engineered for a raging bull market. But if the crypto market suddenly freezes and liquidity dries up, what happens to that massive debt schedule? Are they currently building an impenetrable, unassailable financial fortress? Or are they constructing the most elaborate, highly leveraged trap Wall Street has ever seen?
That is the multi-billion-dollar question, and the answer won't be found in their software revenue. It will depend entirely on the unpredictable, volatile nature of the single digital asset they have tied their entire corporate fate to.
And that profound uncertainty is exactly what makes this stock the most fascinating asset to watch in the market right now. We want to hear your perspective. Are you team bull, ignoring the dilution and strapping into the rocket ship? Or are you team bear, watching the hull get sold off for parts and waiting for gravity to take over? Let us know down in the comments. Thanks for taking the deep dive with us today. We will see you on the next one.